Robschild, nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, millionaires don't need astrologers, but billionaires do, and so we begin. Today is Thursday, May 30th, 2024. Some people have been talking about the GDP revision as being weaker than expected. I didn't care. That didn't affect things very much in my opinion. The more notable data that came out today that caught my attention was the pending home sales for April. The last reading of this for March was a growth of 3.4%. Of course, you know, there's a seasonality here, and so you can't just follow if it's negative or positive. But, you know, nonetheless, the expected was only negative 0.4%, and in actuality it was negative 7.7%. And so, to my eye, that looks fairly significant. Pending home sales are going down. If you look at rents right now, they're actually negative too across the United States. Rents are currently going down. As I've been talking about for months, the Fed has been strangling the economy, and the cracks are starting to show the way it should. You know, we had inflation so high for so long that, like, you know, as bad as disinflation or as bad as deflation can be, I mean, I'm welcoming it at this point, and I think a lot of other people might be too, depending on what, this is the thing, and depending on what you're invested in, depending on your business, you know. But for better or for worse, things are slowing down. The most important thing that I really have to talk about today is the fact that tomorrow PCE data is coming out. And I'm going to take a look at a historic chart of that in a moment. And I wanted to mention again, next week we have Friday, the all-important unemployment number. Again, this has been going up and up and up and up and up. The last reading was 3.9. Is it going to break? Are we going to see like 3.6, 3.5? Or is it only going to go down to 3.8? Or will it surprise us to the upside? We'll see. If I use my crystal ball, I think that unemployment is going to start going up at a faster and faster rate. And I think that will be evident this coming Friday. You heard it first here on Robschild. Before PCE data comes out, let's take a look at the chart here. This goes back to May of 2023, the personal consumption index, and we have, or expenditures rather, you know, it was 4% year. This is a year-over-year chart. So but from May 2022 to May 2023, it climbed 4%, and since then it dropped. We went up and up and up a little bit, dropped significantly in October, all the way until the beginning of 2024, where we dropped, where we're, you know, granted, these are positive numbers, so inflation is still going up here, just at a slower rate. And, you know, but, you know, we got down to 2.5% year over year in January and February, and we ticked up to 2.7. And now what the market has been pricing in and expecting, the consensus here, if you look at it right here on this little chart here for tomorrow's data coming out, is for it to stay at 2.7%. And so again, my crystal ball tells me that we are likely to see this actually go down. I'm expecting it to go down further than other people. I think, you know, the trend from the beginning of even of this chart has been going straight down. What's keeping it from continuing down? This is what I'm wondering. What is there's nothing holding it up. We have the opposite. The Fed's federal funds rate is still significantly above the inflation rate right now. It's currently strangling the economy, and the effects of what the Fed does and changes, you know, it takes 14 months for that to come into fruition. We're here. I think we're here. I think we're at the point where things are slowing down. I'm expecting this number to be lower than the 2.7% number, but we'll see. I said earlier this week in one of my shows, might as well not watch my show or any other shows or any economic things going on until Friday. I still hold that stance, but why not? I do a daily show, so why not go through the charts? So we have the S&P 500. This is a weekly chart. Every candle represents 1 week of trading. As you can see, we had a doji for last week, and I mentioned that this can oftentimes represent the top of a market, and so this really could be a top last week, and we could be crawling over here. Of course, I thought that this was a top all the way back in March, and that was wrong. We went to a higher high, not much higher, to give myself some credit here, not yet anyway. But again, I'm bearish here. I think that being long in an overvalued stock market while trying to fight the Fed, it's a losing battle. Like I've said before as well, I think it's less of a gamble to actually short in these conditions than it is to be long. I'm neither. I'm mostly basically long treasuries right now. On the daily time frame of the S&P 500, this is SPX on tradingview.com. You can see that we have been kind of like, well, we had this little wedge here. Hold on. For some reason, I have to reload the page in order for any of the drawing tools to work. It's really annoying. But anyway, we had this wedge. We had this engulfing red candle here. And, I said yesterday, yeah, we hit the bottom of this. And so that wasn't a break. And we saw a break today. And so this can signify, it adds to the bearish case right now of the S&P 500 headed lower. Again, with the PCE data coming out tomorrow, if it comes out as I expect for it to be weaker, it will actually support stock valuations for the extreme short term. People get excited about potential rate cuts. Unfortunately, it seems that the market never learned that rate cuts are not actually a good thing, because when they're cutting, it's because they see problems ahead. It's not because they want the stock market to keep going up in value. It's the opposite. They see it eventually rolling over, and so I don't know. Anyway, moving on to HYT, high yield corporate bonds. I mentioned yesterday how it broke down here along with the value of treasuries, and then today we had the opposite. We had a little bit of a rally back to about this line, interestingly. So again, my expectation, I'm bearish on this, but I'm not betting on it. Moving on to the VIX. I found it notable that this previous trend line that we had broken below and then gone way to the moon and then below, we are actually closed basically right on it today. Again, the way I look at this chart for today is that it's like going to a more neutral position before PCE data comes out, and we can react to that. I mean, in the really short term, like going into the unemployment data, I don't expect markets to go very crazy one way or another. Anything can happen, but again, that unemployment number on next Friday is like the biggest, most important piece of data coming out in the near-term future. Speaking of the VIX, I just wanted to bring, I do check this chart every day, and I have been fascinated how lately we've had inversion between October and November futures VIX, the term structure. And so I find it interesting because this is not supposed to be like this. This is supposed to go straight up, and so people are seeing the next October. I mean, yes, October can be a volatile month. I don't think it's normally like this though, where you have a spike in October. It's almost like markets are pricing in a stock market collapse, a higher chance of a stock market collapse in October than they expect later than that. There's usually, the VIX futures, there's a premium for buying it further out because you don't know the future. And so it's supposed to just curve upwards nicely, except for when things are going crazy or something crazy is expected to happen. Yeah, you'll see it go up higher than the future price of it. So anyway, that's been catching my eye lately. It's been staying like that. It's not like a one-time thing. October has been like, okay, things are going to get worse in October. But anyway, moving on to the Fear and Greed Index. We're borderline fear today, 45. Yesterday was 47. I said it looks like we're headed towards fear again, and it still seems true. Last chart I wanted to mention is the TNX. I mentioned how very surprised I was to see us break right over this previous trend line in the TNX. You know, I had actually, because of getting to this near this line here, I added leverage to my bond part of my portfolio, which is 50. It is 50% right now, and so that was unwelcome surprise by myself. But as you can see today, we actually closed below this line, and so what it's starting to look like now is that what can happen with these lines, they can act like magnets, and we can fight at this line before it decides to either break out higher or lower. Oh, can't turn it off. While I'm not betting on a lot of things in markets, I am betting significantly that this will break down significantly. I'm expecting the 10-year to get below 4%, closer to the 3.5% level. That's all I have for you for today's show. Hope you enjoyed. Thank you for watching. Robschild.